Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where my guest is Ben Preston, Director, Orbis Investments, London. Welcome, Ben.
Thank you for having me.
It's a great pleasure to have you here. Ben, the last decade gave investors phenomenal share market returns. In fact, made it look easy for a very long period of time, and that's changed a little bit more recently. So using history as a guide, what can investors expect as we head into 2024?
Well, we might expect that the years ahead will be different from what we've just had in the past, because the environment has changed. We had a really long period, actually 40 years, of declining interest rates, declining inflation, a world of peace, globalization going in a forward direction. All of that has changed now. The cost of living is up, inflation has been rising, interest rates have been rising. We have wars breaking out. And so we might have something quite different in the years ahead than we've all got used to as investors.
Orbis is a long-term, contrarian, value-based house. So from that perspective, do you see the current environment as really a major inflection point?
It might well be a major inflection point. And what we found is if you look at areas of the market, perhaps countries, sectors where others have been a little bit less willing to go for, then we've found some great value there, which has been overlooked.
So how can investors really position themselves to profit from this confused and changed global picture?
I think the idea is focus on each individual company one at a time and try to think about what that's really worth. And that's what we do all day. And when we find a share that we think is trading well below what it's truly worth, then we'll buy it and we'll keep it simple.
Being contrarian, is that sometimes a lonely road in the stock market? When the old saying about the market can stay irrational longer than you can stay solvent, the market can stay enthused about things that you're not for a long period.
Yeah, it can. And humans, we are inherently social creatures. We like to be popular within the crowd. It's very unnatural actually to want to be on your own. So if you are with the crowd and you're wrong, it feels like at least you've got some company. If you're a contrarian and you're wrong on your own. And so that's the risk and that's why people don't like doing it, because it can feel very stupid and lonely when you get it wrong. But the rewards for doing it more than compensate for that.
From your perspective with this philosophy, how often does a contrarian have to throw in the towel and admit we might be wrong?
Yeah, no, that happens quite a lot. And what we find is even if we're doing really, really well, we're getting kind of 60% of our decisions right and 40% wrong. So what's the best that you can do with the 40% that you get wrong? Recognize it early, sell, move on and go and buy something else, because no one gets it right all the time.
There's a lot of vehicles, Ben, that make it easy to invest in global markets on an index-based vehicle. But there's things such as survivorship bias, which I think there's a lot of people understand more these days, that small numbers of companies over the long term deliver the returns of indices. Yeah. And secondly, concentration risk. And the Magnificent Seven is such a great example of that. They've been wonderful stocks, everyone loves them, but how risky is the fact that they are doing such a large amount of the heavy lifting?
Yeah, 7 magnificent companies. I think whether they are all 7 magnificent investments from this point is an open question, because while they're great companies, the expectations that are already built into the share prices for their futures are expecting so much now that they've got a lot to live up to. And if they fall short of that, that can be quite dangerous for investors. We prefer to go for opportunities where there's not so much hope and expectation in the price. That's where you can find more of a bargain, if you like.
And not just concentration risk, but we've seen that a lot of investors who think they're quite well diversified are actually too concentrated in recent winners and recent styles that have gone well. So how can investors, in your view, really guard against that trap of feeling diversified, but actually not being in practice?
Well, this is quite an unusual time in stock market history where such a large amount of the overall market cap of the world is concentrated in just a handful of companies. So if you are investing in a global index, you might think you've got a nice broad exposure. It might be that actually you've got quite a lot of your savings tied up in just a small number of companies, and that maybe doesn't give you the diversification that you might want. And in fact, we're at a point where maybe active investors, actively managed funds can give you more of that diversification and play that role for you.
It seems that value managers are really, and active value managers are really back in town, because to have a portfolio or an investment that gives you a different performance from the index, you really have to have a very, very different portfolio to the index. So is it your time in the sun as a value house?
Well, it could be, and we hope that it's the turn of value-conscious, contrarian investors to shine. Now, it's been an environment where it's been quite hard to keep up because the stock market has been powered by such a narrow group of stocks. I think of it as we've been running hard up the down escalator. We've been adding value in terms of the returns that we've been generating, but the benchmark has been so strong. The danger for investors is if that narrow group of stocks stops performing, that's what's been driving the index, maybe things go the other way. So for us and for contrarian stock pickers, that would actually be not so bad, because then we would find that the value that we found would shine through.
Tell us about the ideation process at Orbis, the size of the team and how you come up with ideas, and how quickly could an idea make it all the way from an analyst proposing it to the firm buying it?
We have about 40 analysts in our investment teams. A lot of those sit in London and they look at one sector each. Industry sector might be financials or healthcare. And then we've got some regional teams that might look at just Japan or just the US. Each of those analysts is turning over a lot of stones, looking at one company at a time, trying to find great value. When they find something they're excited about, they bring it to us. And so as portfolio managers, we can afford to be very picky because we've got 40 analysts bringing us maybe 3 or 4 ideas each per year. And so we can afford to pick the very best of those, and that's how we build the portfolio.
So bubbling up from your team at the moment, Ben, what's a really good value opportunity that's pretty intriguing to you right now?
Well, something that's quite unusual, where we see a lot of value, where most investors kind of maybe would find it a bit perplexing, would be something like Korean banks, where there's actually quite a lot of good news going on in terms of the reform that those banks are undertaking, but they've got a reputation for being a bit sleepy, not paying enough out as dividends, corporate governance being a little bit behind where it needs to be. If those things change, they could be really quite attractive from today's starting valuation.
And Constellation Energy, what's the thesis behind your interest in that particular company?
Constellation Energy is the largest nuclear power company in the US. And when you say nuclear power, people's minds go to Chernobyl and Fukushima and all the things that could go wrong. If you look at the stats, the safety record is extraordinary, particularly in the US, and the number of accidents and fatalities per amount of energy produced. Nuclear is safer than wind. People don't realize. And it's the only energy source that provides electricity that's not only carbon free, but it's also reliable. It doesn't have the intermittency problem of renewables, and it doesn't have the carbon problem of coal and gas. So it's very valuable energy, and you can buy Constellation Energy today at a significant discount from what it would cost to build those assets from scratch today.
Which raises the obvious question, Ben, about ESG overlay at Orbis, part of the process inherently, or an overlay after the fact?
Well, we call it responsible investing. And we've committed to some principles when it comes to responsible investing. What that means to us is taking account of all the things we need to take into account when it comes to making an investment decision, whether that's environmental, governance, social. And then once we own a share, to act in good faith as stewards of our clients' capital. And that means we take those things really seriously. And that can uncover not only risks of where stocks could go wrong, but also opportunities where maybe a company has a really good environmental credential that's not factored into today's share price. And that's where we can get excited that things might go their way.
This has been In Depth with Ben Preston of Orbis Investments. Thanks very much, Ben.
Thank you.